So hi everybody, this is Also Hub. I'm Giacomo and today I'm going to analyze Zillow. This is one of the stocks that you asked me to analyze. So yeah, we'll see if Zillow has some value for the possible investors in the company. So before we get into the video, a few disclaimers. This is not financial advice. Do your own research before investing. And second, the data that I've taken comes from the New York University website and Seeking Alpha. So if you want to access the data that I've used, you can get the offer that you can find in the description below, link below. So let's get into the video of today. Zillow. The first assumptions that I've made in order to come up with a price target is the calculation of the weighted average cost of capital. We start off with the cost of equity. So I've taken the interest rate swap for the next 10 years, that is around 4% as of now. And I've taken the risk premium. The risk premium, I've used the risk premium that you can find on Aswath Damodaran's spreadsheets for the year, and this year he pointed out that the US has a risk premium of 4.6%. So yeah, I've used Aswath Damodaran's estimations for this analysis. Then we get into the cost of debt. I've also taken the interest rate swap that is around 4% and the spread, that is around, I estimate it to be around 2% because it has a low debt to equity ratio. We can maybe increase that a little bit and see how that plays out. Yeah, it has a pretty low debt to equity ratio. Here's the debt to capital. So it's pretty stable and not too risky. So yeah. Also, we have to take into consideration that I've taken the last 24 months beta. That is pretty high, but given that we're making some estimations and that could change the weighted average cost of capital a lot, maybe we can make it a little bit lower than that. Given that it's just for the past, we have to estimate what it's going to do in the future. Maybe we make it a little bit less than that. And we can see how that changes the weighted average cost of capital, but yeah, we can keep it for now as the last 24 months. So here's some highlights for Zillow, what it has done in the last 10 years. We can see that the revenue has gone up very steadily. The earnings are not there, but when you see a company that has high free cash flows, high revenue growth, it's probably investing a lot in research and development. Zillow is a technology company, so we have to pretend that Zillow invests a lot. So yeah, I'm not too scared about the earnings being negative because we can see that the free cash flows are positive, and it could also, Zillow could also get some tax benefits by accounting this way all the amortizations, research and development expenses, and so on. So let's make some assumptions for what we can expect going forward. I've kept this beta so that it's high. It discounts a lot more, and we can make it. Here's a very conservative estimation, 15%. That is less than half of what it has done in the last 10 years. So yeah, I've stayed very conservative, but we can see how the price target changes based on the changes that we make in the assumptions. So here's the growth that we expect given these ratios. I've used this one for until the end of the year, 6%, then 15 for a few years, and then 7, and then I've used 3.1, because it is around the growth estimate for the GDP in the US. So yeah, I think it's fair to say that yes, it's a technology company. Yes, it can grow a lot, but it's also based on how real estate does. So real estate is very much dependent on how the GDP as a whole goes, and vice versa. The GDP is dependent on how the real estate market goes, and we can see that from what has happened in 2007 and 2008. So yeah, and Zillow suffers a lot when the real estate market goes down. But I think that Zillow has some good years ahead because interest rates are expected to go down, so probably the transactions in that field will increase as well. So yeah, here's the assumptions. Here's the net debt. It's actually a positive figure, this one, because it has cash. So here's the terminal value calculation. Here's the formula that I've used so that you can do it too, if you want to see it, and if you want to do it yourself, here it is. So yeah, next we see the options. It has around 32.5 million outstanding options, and the exercise price is 44. The weighted average exercise price is $44. So yeah, as of now, the value of those options, I didn't use the Black-Scholes model just for simplistic reasons. So maybe the figure is a little bit higher than that, but you have to take into consideration that statistically it has been proven that options are exercised way before the expiration date. So yeah, maybe it's probably the actual value is probably a little bit higher than that, not something that could change this valuation completely, but yeah, I've done it the easy way. Then we have the calculation of restricted stock units, performance stock units. I believe those are just restricted stock units for the management, and I've calculated the value of these bonuses. So that is around 500, almost 600 million. So here's the value that I come up with, and I divide it by the number, the outstanding shares number, that is around 236 million shares. So here we come up with the value that is slightly below the trading price, the last trading price that I found online. So that was 47.8, but we can see that we've made very pretty conservative assumptions, we have to say. We can see that, for example, if we decrease the beta, if we expect, for example, the beta to go down in the next few years, the cost of capital goes down as a consequence. So we can see that how it impacts the valuation. Yeah, it goes up a little bit. We can see that I wouldn't expect it to go down dramatically, but a little bit, probably yes. So we can see that it could draw some changes. We can make assumptions in case the company grows more than what I previously expected. Let's see what happens if we say that it grows 20% year over year for the next about 2.5 years, more or less, and then 10%, and then it stays at 3.1% for the long run for the perpetual growth figure. And we can see that we can see some value in this case. We can see that in this case the share value would be almost 20% higher than the current share price. So yeah, I made some pretty conservative estimations. So yes, there can be some value, but to me it's not like a very visible and clear opportunity. It depends on a lot of things, especially interest rates to go down. That is the most important thing for the business. So if the interest rates would go down, more transactions, more people buying houses, starting mortgages and so on, and also it would benefit Zillow from a cost of capital perspective. So yeah, we can see that we can see what would happen if, for example, we make a slightly lower assumption on the weighted average cost of capital, and we can see that yeah, it increases a little bit. It was around 18, now it's 19. Yeah, not that much, but yeah, we can see that what happens if over here it goes down even more. Here the change is more visible because it affects the terminal value. But yeah, I think Zillow is a pretty good company, well positioned, very good technology, underlying technology, but given the price that it's trading at, it's not a clear value opportunity. It is a good stock. If it were to go down in the short run for any minor issue, I would probably make it a buy. But as of now, it's not that clear that is actually an opportunity, and we can see that all these assumptions, just remember, are just assumptions. Things can change very quickly, very dramatically, so don't over rely on just assumptions. Give yourself some margin of safety. So yeah, these are my assumptions for Zillow. Let me know what you think about them. So this is it for today. Make sure to like, subscribe, and comment for the next stocks you want me to analyze. This is it for today. I'm Giacomo. This is Hustle Hub. See you next time.